Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 28th of January 2016, and we're going to cover the FOMC announcement issued at 2 p.m. yesterday. This is what the Fed had to say. Quote, information received since the Federal Open Market Committee met in December suggests that labour market conditions improved further, even as economic growth slowed late last year. Household spending and business fixed investment have been increasing at moderate rates in recent months, and the housing sector has improved further. However, net exports have been soft and inventory investment slowed. A range of recent labour market indicators, including strong job gains, points to some additional decline in underutilization of labour resources. Inflation has continued to run below the committee's 2% longer-run objective, partly reflecting declines in energy prices and in prices of non-energy imports. Market-based measures of inflation compensation declined further. Survey-based measures of longer-term inflation expectations are little changed, on balance, in recent months. So what the Fed is actually saying here is that although there was a reduction in the rate of growth towards the end of last year, overall the economy is improving. And as a result, as indicated by the jobs increase, they continue to expect that improvement, however, admitting that inflation has not reached the target that it has set. Let's go on to the next part of their statement. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. The committee currently expects that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace and labour market indicators will continue to strengthen. Inflation is expected to remain low in the near term, in part because of the further declines in energy prices, but to rise to 2% over the medium term as the transitory effects of declines in energy and import prices dissipate and the labour market strengthens further. So again, what it is actually saying is that yes, we see an improvement both in the economy and actually in inflation as oil prices eventually bottom and then start to rise. It then moves on to say, given the economic outlook, the committee decided to maintain the target range for the federal funds rate at 0.25% to 0.5%. The stance of monetary policy remains accommodative, thereby supporting further improvement in labour market conditions and a return to 2% inflation. Now this is a very clear indication that they are going to remain slightly dovish in terms of the amount of money being pumped into the economy. They wish to see a continuing improvement in employment, and therefore one should not be surprised to expect interest rates not necessarily to rise as quickly as one anticipated. That is, in March of this year. Now, other comments they have actually mentioned suggest that they have not ruled out interest rate rises in March, but by following this, one can be reasonably confident that unless the economy really advances at a significant rate, which is not likely, then a rise in March is very unlikely. The statement then goes on to support the fact that they shall be monitoring both the inflation rate, the employment rate, and also other economic indicators from around the world, stating that they accept that short-term interest rates will, for a while, be lower than their longer-term targets. So overall, to us, this suggests that the Federal Reserve realizes the economy, though growing, is very fragile. The effect, therefore, is to ensure that they continue with that growth and do very little in any way to actually impede it. So what we can read from this, without any doubt, is that they shall remain dovish for a little while, but they are not immune to the fact that eventually interest rates will have to rise. But with falling stock markets, with the sales actually being disappointing in December, retail sales, then there is no doubt that for a while they have to maintain the status quo. So in terms of gold and silver, this technically should be quite bullish. Having said that, we have seen the prices drift back ever so slightly since the announcement. As we have said in previous videos, we expected January to be relatively strong for gold and silver and into the very early part of February. However, we still, at this stage, are not particularly bullish about either of those metals as we progress into the first half of the year. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at www.illuminatisilver.com and look at our Facebook page, which is updated daily at www.facebook.com/Illuminati Silver. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.